we're looking at over $1.2 trillion this year to finance the debt. And that's a function of two things. One, the size of the debt, but two, these higher interest rates. Well, the more you borrow, and that interest expense accounts for more than half of annual borrowing costs, the more you have to borrow, the more you're increasing the demand for loanable funds, which means you're going to increase the price of loanable funds, which is the interest rate. So this is where you get into that negative upward spiral, you could say, a debt doom loop, where the more you borrow, the more you drive up interest rates, which means the more you borrow, et cetera, et cetera. That's where we are right now. How do you break that cycle? To your point, you need to start by cutting spending elsewhere. And doing so will reduce how much you have to borrow. And now all of a sudden, you're not putting as much pressure on the loanable funds rates. That does help bring down interest rates, which in turn reduces the deficit even further. And now the spiral goes the other way.